Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, August the 26th, 2025, recording this in the morning as always. Okay, let's have a quick look and see what's happening. Quite interesting news out of France, which is causing some global markets to readjust a little bit. We can see here the CAC 40, which is the French index. You see a big sort of drop. This is the stock index in France, a big drop. And why is that? Essentially, the French Prime Minister, PM Bayrou, has called for September the 8th a vote of confidence in his government, basically to do pension reforms and austerity and to cut the budget and cut expenses. There's going to be a lot of street demonstrations, but essentially on September the 8th, he wants legitimacy for that to be voted in by the French Parliament. Now, both the left and the right wings of the parliament, Bayrou himself is more of a centrist, have essentially said that they will probably vote against that, which could cause the government to topple. So the reason this is interesting is that it raises this whole spectrum of political instability within France, which of course is one of Europe's biggest economies, and also within Europe itself. And so just therefore, from a market perspective, we see here the CAC 40, which as I said is the French index, of course, that have a sort of opened pretty low. But what's interesting is also just the reaction of the bonds. And we know that the OATs, we know that the French fiscal situation is getting a little bit out of control. They're not doing particularly well. And what's interesting is that if we look at this spread between the Italian 10-year and the French 10-year, you can see that, essentially over the last, I mean, just scrolling back here, would have to go all the way back sort of a year and a half. That had been at about 1.5%, 150 basis points. And as you can see here, it's just been grinding down in favor of the Italian paper, and you can see here now the spread is only basically a tenth of 1%, so 10 basis points. So we've had a drop here of 140 basis points, which is meaning that the French the Italian spread over the French yield has come almost to parity at this point, basically a parity, which is pretty incredible. So that's a sign that the market is giving more confidence to the Italian sort of management of their economy and their fiscal situation, whereas it's perceived that in France that fiscal spending is basically out of control and the economy is weakening and there's too much debt issuance. So that's the spread between the Italian and the French. But let's now just have a look and see the performance, see what happens. So if you look at the FOATs, which is the French bonds, just from a price perspective here, you can see that they've had a pretty nasty sort of fall in the last 24 hours or so. But that's also been mimicked a little bit by the Italian bonds. Although not as much. You can see in Italy, not as much. So look at that here. So you're just going back to France, you see France and there's Italy. And then, of course, if you look at the Bund, which is up here on the 10-year, you can see that they're actually gone up a lot. So it's interesting that the Bund has reverted to its traditional kind of safe haven within Europe kind of context. So we've had the Bund outperforming the Italian bond, which is interesting, which is outperforming the French bond. So that's a little bit of a turnaround. So just in terms of the spreads here, you can see that the French spread over the German spread, you can see that that's ripped much higher. So definitely the way to be playing this is the spread trade. So obviously selling the French bonds versus the Italian bonds, but much better to be selling the French bonds versus the German bonds, the bunds at this point. You can see here we've had that go up about 5 or 6 basis points. So in terms of the currencies, again, interesting. The big question is, will the euro weaken on this? So if we just look at the euro, we can have a look. Now, the euro's got cross currents, of course, with the US dollar. So probably the best way to play this again is a spread trade, relative value kind of trade. So probably really what we're going to be seeing here is the euro potentially weakening against, let's say, the Swiss franc. So the Swiss franc here coming in as a bit of a sort of a safe haven. And we saw that on the news yesterday, just coming back a little bit now, the euro. But that's going to be an interesting one to watch. If that situation does sort of degenerate a little bit or deteriorate, I should say, in France, we could see the euro here coming down against the Swiss franc. That would be something to hold on there. But of course, the euro, it's going to be determined a little bit about the US, which we'll get into in a second. The other interesting cross pair could be euro JPY. Let's just have a look here and see if the euro, this does seem to be a topping formation here, does seem to be losing, running out of a little bit of energy. And if we just look at the some of the, let's say, the moving averages here, which I'll put up here. So we've got the EMAs. You can see here that the shorter term ones, the faster ones, like the 20, is starting to roll over a little. I don't want to say roll over. Let's just say flatten out and do a sideways consolidation, just losing a little bit of momentum, but still well above the 50-day moving average, which hasn't been breached for a couple of months here. So let's just keep an eye on that. And then finally, looking at the euro to the the British pound. We've also seen that the Bank of England has been, fighting back a little bit hawkish recently. That combined with, let's say, potentially some political uncertainty within Europe could see the euro pound just sort of falling a little bit at the 50-day moving average here, the EMA. So let's see what happens there. So as I say, probably the best way to be playing that sort of political uncertainty in France is either by shorting the French stocks or French ETF, or playing the spread is probably the best way. So long Bund or long Italian versus short French bonds. And then, of course, possibly Europe on one of the cross spread, one of the stronger currency on the cross spread. Maybe for simplicity's sake, long Swiss franc, short the euro. That's an interesting one. And as I say, we're going to have some politics leading up to September the 8th, which is still a couple of weeks away. In terms of other stuff, just going to grab some water here. The other big news overnight, of course, is that Mr. Trump, the president, has decided to fire a member of the Fed board, Lisa Cook. Now, this is interesting because Trump believes that he has cause, that he has a legal justification. There were apparently sort of irregularities on her mortgage applications for Dr. Cook. Dr. Cook, Lisa Cook, she's issued a statement. She issued a statement late last night, actually, essentially saying that she has done nothing wrong. There were no irregularities. There's no legal justification to remove her, and that Trump does not have cause. So it looks as though this one is going to be a legal battle, and it could go all the way to the Supreme Court, which is going to be very tricky. It's going to be tricky for the Fed as well, a bit of a side point, because this could put Powell under quite a lot of pressure. Why is that? Because let's say, for example, Powell allows Dr. Cook to continue her duties working at the Fed and making decisions on monetary policy and Federal Reserve business. It could be that even a few months down the track, that if a court were to decide that were to agree with Trump and that he did have the justification and the legal power to fire her, essentially that would be a retrograde decision. And that would mean that the Fed, and in this case, Jerome Powell, would have made that would have been a sort of a legal error to have allowed her to work, to allowed a fired employee to continue to make decisions. And this is interesting, and that act could give Trump then cause to fire Powell. Now, this is all a bit hypothetical, but you see that the stakes here are quite high. And very clearly here, Trump is pulling out all of the stops in a fairly sort of unvarnished and brutal and direct way to try and get as a majority on the board as soon as possible. We already had Adriana Kugler resigning, so now, and Stephen Mirren. So now, if Cook stays, or let's say doesn't stay, it's going to be problematic. There's another two people, plus we have Bowman and we have Waller, who are kind of Trump appointees. So we're getting to the point now that on the Fed board, really the pro-Trump, or at least those who are sort of more sympathetic for Trump's view of cutting interest rates, are becoming more numerous and more powerful. And certainly things are getting pretty sticky from a political point at the Fed. Now, from a market perspective, what does this mean? First of all, from a big picture global perspective, again, maybe this is not something you can trade every 2 minutes, but in terms of the politicization of the Federal Reserve specifically, but also more generally the whole apparatus which goes around monetary policy in the US, so the issue of treasury bonds, who's in charge of the treasury, the Fed, the way of appointing people, firing people, all of this politicization of that whole ecosystem is definitely being how can I say, weakened and undermined. I think there's not too much argument about that. And ultimately, that could be sort of show a little less confidence in the US dollar and in the US treasuries, in US bonds. Again, as I say, this is a very big picture thing, slow moving, glacial 5, 10, 15, 20-year time frame. But it is interesting just to see what's happening and how these things do begin. Now, in terms of specifics, the US dollar, just on that news, so let's just go to the dollar index on that news, which it was about 8 p.m. last night. When Trump sent his sort of letter, shall we say, on the US dollar. So we see here the US dollar. Okay, so let's just review and see what's happening here. First of all, it's still in a major sort of downtrend. That's the thing here. Any rally here was whacked down at the 100-day moving average a few weeks ago. And you can see here that it's still essentially trading sideways and trading heavy, shall we say. Now, after the Powell's speech last Friday at Jackson Hole. The US dollar sold off, had a bit of profit taking and maybe just a bit of a retracement yesterday. But subsequent to the Lisa Cook information overnight, the dollar is trading a little bit under pressure. I mean, it's certainly sold off quite hard, about 60 basis points for half an hour or so, and has come back. But the point is that it's trading sort of heavily at this point, and there's no reason to suspect that that's suddenly going to bounce at this point. Why is that? Because the market is really just pricing in here the fact that the Fed, of its own volition, because of the data or whether it's just political pressure, is becoming under more and more pressure to sort of be cutting interest rates, and so the market is starting to price it in. So therefore, that's bad for the dollar. Secondly, you just in terms of the bonds, just in terms of the yield curve here, let's just have a look and see what's going on here, because obviously the classic reaction here, we see the front end of the curve, which is going to so this is the ZT. So we see the front end of the curve pushing higher, and that's a lot more sort of sensitive, obviously, to monetary policy. So if we have a situation where the Board of Governors is being forced or obliged or wants to cut interest rates, that is going to benefit in the shorter term. It's going to benefit at the front end of the curve. So we see the ZT pushing up. But what that means is that there's going to be, and let's now look at the 30-year bond, and we see here red. So you see this, there's the 2-year. Just have a look at that, see where that is. Bit of a bull flag here, potentially flagging to go higher. And then suddenly we go out to the 30-year, and we can see that nothing of the same situation. It's red. And so we're getting a steepening of the curve here. And that's basically on the idea that if the Fed is less focused on fighting inflation, that is not good for the longer term. And secondly, just the term premium needs to go up, or is going up, on the long-term bonds. Just the risk of holding the 10 and 30-year, that because of the uncertainty over the future path of inflation. And finally, just sort of issuance. We have the Trump administration, which came in the first month or two and made a lot of noises about government efficiency and Doge and Elon Musk cutting jobs, et cetera, et cetera. It hasn't really happened in any great sort of form. And so there's still the problem here of unbridled spending and a lack of fiscal discipline, which is bad for the long end. So all of that is going to cause a steepener. And if we actually just now look at some of the curves, let's look at, let's say, the two. So just looking at the yields here, so you see here the 2-year yield pushing down towards the bottom of its range, and you go out towards the 10-year, you can see here not nearly as much, and then you look at the 30 here, you can see that that's actually much higher. So if we look at the relative value, obviously the way to play this is the yield curve. A spread trade again is the best way to be playing these kind of situations. So we've got a 2s to the 30 breaking out of that range. You see it's been in that long trade range for 3 or 4 months, basically breaking decisively above it. And I think I showed you yesterday or a couple of days ago. Let's just have a look on a weekly chart and just see where we can get to here. And you can see here that that's, it's got plenty of more room to go up. It could have a little bit of resistance at about, let's say, 130 or so, 1.30%, 130 basis points. But, the reality is that this could grind up to, 160, 165 basis points. So another 30 to 40 basis points just over the next few months, if we still get this combination of sticky inflation, a Fed cutting, and political pressure, and also continuing sort of debt issuance on the long end. So there's the 2s, 30s, and a similar kind of situation in the 2s, 10s, maybe not as dramatic, but definitely some kind of steepening happening. So overall, the 30s are going to be trading heavily at this point. And talking about the other thing, which is actually we also have the auctions happening today. That's what I wanted to mention, but mainly on the front end. So we have the beginning of the front end cycle. So today we have the 2s, then we have the 5s, then we have the 7s. It's going to be pretty interesting to see if there's going to be some differential in terms of the auction performance between, let's say, the 2s and something like the 7s, which is on Thursday, I believe. Yes, that should be correct. It was on Thursday, just to see if the overall global market, market participants still have appetite to get into the belly of the curve. The other thing, of course, is gold is absolutely loving all of these shenanigans. So you see here that gold is pushing higher. This is the December contract. So it's just in a sideways consolidation. So, but at this point, this is still quite bullish. It's above all its moving averages here. You see that it's sort of a dip below the 50 for a little bit, but it's now above the 20 and the 50-day moving average. And it does look as though it wants to push out. And honestly, if you have sticky inflation, a Fed not really fighting inflation aggressively, you have some political uncertainty in Europe, you have, let's say, some political shenanigans, within the US as well, and we have a weakening US dollar, and we also have sort of sort of central banks globally around the world who just consistently continue to buy gold bullion. This is all positive for gold. So you've got to say that here gold, it wouldn't surprise me at all if gold of the next sort of week or 10 days pushes up to 3,500 along towards the top of its range. And of course, where gold goes, silver generally, can follow. And you see here that silver also sort of pushing up as well. That's interesting to look at. Okay, guys, so that's just about it. In terms of the equities, volatility remains at pretty low levels here after Powell's speech. You can see here that the ES, it did have a nice pop. Reached the top of the range, just sort of coming off a little bit. It's difficult to read too much into that. We have Nvidia tomorrow, which quite possibly will have a little bit of stability in the markets, let's say today and tomorrow. But that's probably going to be a big deal. Nvidia, in terms of capital expenditure and whatnot, because Nvidia at this point, as we all know, is a major component in all of the indices, especially the Nasdaq. So just taking a little bit of a pause along the highs here. If we look at the Nasdaq, you can see that it's not quite performing quite as well. And then if we look at something like the Russell, the small cap, you can see that had a nice spot, but is also just taking a little bit of a break. So in general, equities taking a little bit of a break, and just probably looking a little bit at Washington as well, just seeing what the sort of the fallout's going to be from the Lisa Cook, situation at the Fed and Trump and the whole deal there. And of course, Nvidia will probably have a more clarity on that on Wednesday afternoon. The other thing, finally, just to say, guys, just want to have a quick look at the data today. There is durable goods. So let's just have a, oh yeah, here, just quickly while I've got this up. This is the December pricing for the Fed meeting. So you see that after Powell's speech, we got all the way down to about 57 basis points of cuts. But what we can see is that it's just come in a little bit. So I don't want to say hawkishly, but it's just come back three or four ticks or so, 3 or 4 sort of basis points. So nothing too much to read into that. Still fairly dovish at this point. In terms of the data today, we have durable goods. Now this is a very sort of a choppy number, and but the thing is, you have to get rid of things like Boeing aircraft orders. So really, the ones to be looking at here for the durable goods is the capital goods ship non-defense excluding aircraft. So some of these core numbers, not so much the headline numbers. I mean, I guess we can look at them, but really these core numbers here, and that's expected to be a little bit higher than last time for non-defense excluding air. And the shipped orders is expected to come down a little bit. So as I say, quite a choppy number, but I guess we'll have a look at that and see what's going on. Also, we have this morning Philly Fed non-manufacturing activity, which is part of the matrix as well. We also have here the conference board consumer confidence, which again, these surveys, I don't know how sort of valid they really are, but it's all part of the jigsaw puzzle. We'll put it together and get a bit more of a read on the US economy. Okay, I'll leave it there, guys. Hope that was useful. Thanks very much. So let's keep an eye on the European bond spreads and the euro with all the cross currencies, and of course, any tweets coming out of the White House. Have a great day, and we'll keep this going tomorrow. Thank you.